Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. It's a mixed picture for stocks and futures to start a week dominated by central bank decisions, including a likely cut from the Fed. The ECB's Isabel Schnabel says she is comfortable with bets on a coming rate hike in Europe, and she tells Bloomberg she'll stand ready if asked to succeed Christine Lagarde. Plus, China's trade surplus tops $1 trillion after exports rebound. Meanwhile, Beijing reiterates its commitment to support the domestic market in 2026.
Good morning, Anna. Let's talk about these markets. Let's show everybody what is happening. First thing this morning, equity futures reasonably becalmed at the moment. It is, as Anna says, a big week for central banks. You've got the Fed in focus, the ECB. Keep an eye on the BOJ. Keep an eye on what's coming out of China. All of that being priced into equity markets this morning. Net. Nothing to see here. The dollar moved on the Schnabel comments. Euro went up, dollar went down, 0.2%. The dollar story again, front and centre this week. What's going to happen there? And if you're worried about inflation, keep an eye on copper. Fresh records for that metal. We'll talk metals later on in the programme. The countdown to the opening trade. It starts right now. OK, big week for central banks. There are lots of stories to talk about. They all centre around the central bank story. You've got the Fed obviously in focus, but this morning it feels like the ECB agenda is taking the checkered flag. And we continue to watch, obviously, as we build up towards what is happening with the BOJ, the data that comes out of Japan. So a lot going on and a few moving parts that I think are quite interesting this morning. Is the Fed the boring story? Is the Fed priced in? Do we know we're getting 25 basis points? But then comes the readout on how the FOMC voted. So there's a lot still in that narrative too, despite the pricing. Yeah,
the market did seem, to your point about whether it will be as expected, the market did seem to decide a little earlier on in this year, in November, when we heard from the Fed's Williams in the middle of November that there was a 90% chance of a cut. And ever since then, we've seen him pretty much convinced that that's what we're going to get. And so the focus is on the divisions, isn't it? It's the divisions at the FOMC and the dots. And to what extent are those dots, change at the top proof? Are they going to reflect really what the participants think is going to happen in 2026, or are we really just waiting for new leadership?
The question then becomes, what does Trump want? Because this new leadership story, I think, is really interesting. There's been this assumption that Trump wants lower rates. That's been his history. That's what he's always talked about. But Trump has a growing political problem, and that is inflation. And he's struggling to deal with it himself, it feels like. His administration are trying to point him in the direction of talking about what's happening with affordability. If you lower rates and lower them aggressively, is there a danger that inflation goes up? And I think that's the risk that we've got to start thinking about. Does Trump start to reflect that? Is he really going to push us hard for lower rates? And then I think there's the question of, but the flip side of that is, yes, but you get cheaper car loans, etc., if you get lower rates. So this affordability story, I think, is going to get really interesting.
Yes.
The Fed has not got inflation back to target. And does lowering rates aggressively help that story?
Yeah. I mean, inflation is going to be a feature of the conversation still at the Fed, isn't it? And I was just ending the last hour of programming with a chart that showed that, rates have come down. The central bank has been cutting interest rates, but that hasn't really weighed on the 10-year yield, or at least it hasn't brought it down significantly. And so therefore, it is not being reflected in more affordable car loans and mortgages for those in the United States. And that's going to be something that we continue to focus on. Is it that inflation, the supply concerns at the end of the curve, all kinds of reasons why we've seen the stickiness in the US 10-year?
And that presents a problem for both Trump at the White House and the Federal Reserve. Inflation is a political problem in the United States and remains so. And November is coming, and coming fast for the Trump administration. Can they hold on to the House with inflation feeling sticky right now? Let's talk about these comments from Isabel Schnabel.
Yes.
Out of Germany, out of the ECB. Comfortable, it seems, with the next move being a hike. Olli Rehn was making comments about a more balanced picture, but she's basically talking about the idea that we could potentially see the ECB's next move being a hike, which implies that this rate cutting cycle is over.
Yes, indeed, suggesting that this is then the floor. But she's not suggesting the rate hike comes anytime soon.
No.
I suppose maybe that ties in with the market's thinking already. And Schnabel is obviously a hawk, has been hawkish for a long time. So you're right that that's a really interesting dynamic, though, coming through from her this morning. The other thing to pull out from her comments to us this morning, Isabel Schnabel says that she'd be ready to succeed Christine Lagarde if asked. Now, obviously, if the market thinks that there's going to be somebody more hawkish at the head of the ECB, you might expect the euro to go higher. Well, the euro spiked higher on the earlier comments around seeing the hike being the next move. And there's a slight move upwards on that. Could Schnabel lead the ECB line, but not a huge amount. So we'll have, maybe the market is still waiting to see.
Never had a German at the top of the ECB?
Yeah, a lot of talk in Germany about whether it's time that they did have one.
Absolutely. Another female to lead the ECB as well, I think, would be seen as a good thing too. So that both of those two are interesting. But what's her timeline? She talks about it not being imminent. But is it a 2026 story? Could the ECB be hiking in 2026?
Well, my guess on the last hour was saying this isn't until the end of 2026. So this, I mean, that seems like a ridiculously long distance away, doesn't it? My mind can't even compute the end of 2026 right now.
But it won't be that long before you start sort of talking about it more seriously. You get into the spring, and then suddenly the next move by the ECB could be a hike. And that, I think, is absolutely fascinating. Which takes us on to the comments as well from Emmanuel Macron, which will take us on to China in just a moment. But let's talk about Macron's views on the ECB as well. Jean-Claude Trichet used to talk famously about having a single needle in the compass, because the ECB does have a single needle in the compass, and that's inflation. Macron's suggesting that maybe actually there should be a growth mandate in there as well. Now, that would be a huge shift, particularly coming from France. You kind of compare and contrast the Isabel Schnabel, Macron views of where the ECB should be going next, and quite different views. And you wonder whether or not he could gain any traction with this. Yeah,
so Macron may be wanting leadership at the ECB that maybe focuses a little bit less on inflation and more on that growth agenda. And so suggesting, yes, a dual mandate, maybe like the Fed's, would seem to be the conclusion from what he is saying there. So that's one interesting line from him. He's also been talking about, and this does take us on to China, he's also been talking about the possibility of Europe putting more tariffs on Chinese products, which possibly would go down well in the United States.
So there's a line in, I think it's Les Echos. He did an interview with Les Echos, which was published yesterday. We'll talk about the details of China at the moment. The quote goes something like this: "If they don't react in the coming months, we Europeans will be obliged to take strong measures and decouple like the United States." He's just come back from China. So clearly he feels that he did not gain any traction in his message to the Chinese, which is, you need to rebalance, folks. Otherwise, we're going to have to do something about it. And you can kind of see why he is saying that, given the data we've seen this morning.
Absolutely. The United States wants Europe to join it in putting pressure on China to increase domestic consumption so that China is not so geared around exports. And that takes us on to the exports and the incredible export numbers that we're seeing. Despite the fact that China can't export so much to the United States, well, that doesn't matter, folks, because they send it to Latin America and they send it to Europe instead. And then we're back to thinking about inflation here in Europe.
So you've got... This is November data. I think it's 1.1 trillion. The surplus that they're running, the export surplus that they're running, in terms of the numbers that we're seeing. US numbers are down by 29%. But as you say, Latin America and Europe is making up for that. Europe is making up for that. You can see why Macron's upset. These are the kinds of numbers that we're talking about. Now, they're saying this morning, and there's lines out of the Politburo meeting that has taken place, that they are going to boost domestic demand, and that will be a priority. But you're not seeing it in the data at the moment, and China is really struggling with domestic demand. It is stimulated. How much more of that are we going to have to see? And it looks like it's going to be significant in order to try and balance those two numbers out. Yeah, and we've seen the US push back against the Chinese export engine as such a big driver of policy and markets over the last 12 months. So we'll see whether the Europeans decide that they want to do something more. Of course, we've seen specific action around cars and those kind of sectors already, but we'll see if this widens out into, as Macron's been talking about, a bigger decoupling. The French have less exposure to China than the Germans. And again, you wonder how that relationship is going to develop in 2026. Lots to talk about. Everybody's making their investment decisions at this time of the year, looking at allocations into 2026. There's a lot of moving parts right now. How are you setting up your portfolio for next year? Well, we'll try and get a view on what is happening here. Paul Skinner, Investment Director at Wellington Management, is going to be joining us. We're going to talk fixed income. Laurelie Renaud-Chatelain, Senior Fixed Income Strategist at Pictet Wealth Management, is going to be joining us. And Melissa Ann Holland, co-CEO of Software One, is going to join us a little bit later on. Agentic AI has been a big theme in the back half of this year. Is it real? Can companies really apply it? How good are they at applying it? What is the cost of applying it? can we take humans out of the loop?
Yeah, absolutely. The focus then on agentic AI in that conversation. Let's tell you what is coming up this week. It is a busy week. We've mentioned the Fed already, but we've got plenty of other items on the agenda to focus on, including US data and quite a bit of catch-up data. So the JOLTS numbers coming through. The weekly ADP suddenly become the big data point in the market's eyes as we've been through that haze, that fog of shutdown. On Wednesday, we get China's CPI and PPI. So as they continue to export to such a huge extent around the globe, what kind of CPI and PPI are they exporting as well? Rachel Reeves appears before the Treasury Select Committee to talk about the budget, no doubt, and the Fed rate decision we've mentioned. We also get an SMB interest rate decision this week and the UK monthly GDP data at the end of the week.
Sorry, what else do you need to know? This Monday morning, the simmering diplomatic spat between Beijing and Tokyo intensifying over the weekend after Chinese fighter aircraft allegedly trained their fire control radars on Japanese military jets. A senior Japanese foreign ministry official reprimanded China's ambassador on Sunday over the alleged incident. Meanwhile, China's foreign ministry said Japan was making, quote, false accusations and lodged counter-protests with Tokyo. President Trump has expressed his dismay at Volodymyr Zelenskyy's handling of a US proposal to end Russia's war in Ukraine. The statement's contrasts with some recent, more optimistic comments from Washington suggesting a, quote, framework of security arrangements had been agreed with Kyiv. Trump's comments come ahead of President Zelenskyy's planned meeting in London today with the leaders of France, Germany and the United Kingdom. And Donald Trump has raised potential antitrust concerns regarding Netflix's planned acquisition of Warner Brothers. The $72 billion deal would combine the world's top streaming player with the number 4 service, HBO Max, which has already raised red flags for regulators. Trump confirmed that he met recently with Netflix's co-CEO, Ted Sarandos.
He's done one of the greatest jobs in the history of movies and other things. He's got a lot of interesting things happening aside from what you're talking about. But it is a big market share. There's no question about it. It could be a problem.
Really quick involvement into this process. Trump clearly feels that this is something that he wants to keep his eye on. I find it fascinating how he decides, how granular he gets and how he decides which ones of these stories he's going to be focused on. The US news cycle has been full of all the Netflix stories. He clearly is focused on the US news cycle and has got involved.
Absolutely, and interesting to see that the Netflix leadership have clearly put an emphasis and a priority on getting in front of President Trump and talking to him about this. So we'll see whether that plays to their favour and they get blessing of US regulators on this deal. Coming up on the programme then, the world's largest ice cream maker begins trading today in a rare triple listing in Amsterdam, London and New York. We will check on Magnum's debut at the market open here in Europe. Plus, we'll also hear from veteran investor Ray Dalio, who warns of rising global debt at Abu Dhabi Finance Week. Up next is Fed Week. We will check in on how markets are moving ahead of that Fed interest rate decision. Widely expected that we will get a cut in rates, of course. If you have questions, if you want to get involved in any of these guest conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back. 7:16 here in Europe. So European equity market futures are negative as we are 45 minutes or so away from the start of European equity trading. Negative, but not by much. US futures a little brighter, up by around a tenth of a percent or two on E-minis this morning. Let's think about the big event of the week, which is the Fed. The Fed Chair Jerome Powell is expected to push through another quarter-point interest rate cut this week. Despite growing unease among some policymakers that inflation remains too high, let's bring in Bloomberg's Valerie Teitel with her take.
That's right. Wednesday is the last Fed decision of 2025. Will we see these more hawkish members of the FOMC kind of shaking the boat when it comes to risk sentiment heading into year end? As you mentioned, there has been a lot of unease from these hawkish members who are essentially not in favor of cutting interest rates. So it could be due for multiple dissents on Wednesday's decision. If we see all of those who did express some unease, some wariness about cutting rates dissent, Fed, we could be up to 5 dissents in this decision, which, Anna and Guy, that is the most dissents we have seen from the Federal Reserve in modern history. So keep an eye on the dissents. Obviously, this lack of data clarity really not helping the Fed make any clear decisions this month. We're still waiting for this backlog when it comes to November CPI and non-farm payrolls, which we are due to get the week following this Fed decision. However, the market is pricing in that the Fed is very likely to cut interest rates regardless of how fractured the decision will be. We are hovering very close to record highs when it comes to S&P futures. Perhaps we might notch that superlative today. It would be the first record high for the S&P 500 index since October. And not only are we getting all of these 2026 outlooks from the street and from sell-side banks, but Bloomberg did a survey of some of the biggest asset managers. No surprise, we are heavily risk-on tilted when it comes to these asset managers' views on the equity market come 2026. And this comes alongside many of Wall Street Bank's biggest trading houses calling for double-digit gains for the S&P for next year. Guy?
I think it's just keep doing it. It'll keep working. Of course it will. Valerie, thank you very much indeed. Let's get more on all of this. Paul Skinner, Investment Director at Wellington Management, joining us around the table. Good morning.
Morning, Guy.
2026. So what I'm hearing in terms of asset allocations, which all the decisions are being made at the moment, lots of meetings going on, is long stocks and long private credit.
Absolutely. And we're priced for Goldilocks. And in our belief, that's the least likely result we're going to get in 2026.
Wow, okay.
No, literally, we think we think 20% chance that we get that Goldilocks. What we actually think is we will get an economic uplift, yes, but that's going to be accompanied with an inflationary pulse. And that is going to mean that central banks, where we've been relying on to cut rates recently and make us all feel good, are going to have to stop doing that. We're already seeing it.
So is this the last Fed rate decision that we're going to see a cut at?
I think there's going to be a really big debate about whether there's another cut coming next year. And that's going to come...
The market's got a lot more priced.
It certainly has. I mean, expecting about 80 basis points by the end of next year. So that's a big reversal. And when valuations are as high as they are now, that's going to create a bit of volatility. And so we're expecting volatility as we go into next year.
OK, so volatility next year. So, Paul, does that mean that you expect a fairly typical, traditional reaction function from the Fed to inflation data? Or does the fact that we're going to get a chair who is perhaps a little more inclined to listen to the politics, that maybe we get something else? Yeah,
I think you are going to see a very divided Fed in this particular decision, and that's the beginning of the sort of thing we're going to see next year. So, yes, we will get a more politicization of the Fed, but the one thing that the Trump administration know is they cannot let the markets, run away from them. And we've got a poster child for this, because if you remember, Abe in Japan, in his second term, fired all the Bank of Japan central bankers, put in a couple of his own guys. They cut rates. Within 2 years, the yen had fallen 28%. So Trump is not going to want a problem with the dollar or a problem with funding his large deficit. And so even a political Fed is going to do the right thing to keep the market on side. And, when you're seeing PMIs, input prices at 63, output at 53, that's a CPI of 3.5 going into next year. And if we don't see unemployment actually, really start to expand, and we do not think that's going to happen, it's sort of low turnover in unemployment, you're going to find it very difficult to cut again.
OK, so that's really interesting. So you're not expecting... So just because the president is talking about lower interest rates, the market shouldn't get carried away in thinking the Fed's just going to do what the president wants, and that'll be interesting to watch next year. Bringing it over to Europe, we've had these really interesting lines coming out of Isabel Schnabel this morning saying she's OK with the next move from the ECB being a hike. Not imminent necessarily, but the market, up until this point, the market's been a little, hasn't been getting many clues from ECB policymakers about which direction rates will move next. We've got a lot of fiscal spend due to come out of Germany. So how would you expect that to play out?
Well, we're excited about Europe. We think that, we're finally going to see, that fiscal spend come in, but what we're hoping is we're going to see the private sector join in with that spend. And if we can get the German consumer, who's been the millstone around Europe's neck for years and years, if they start spending, they start joining in, which we're beginning to see some indications, then we think Europe is actually going to see, a really good economic uplift. They don't have the inflation problem. And, when you talk about pricing in hikes, I think there's about 3 basis points until the end of the year. So it's nothing serious. But so we actually think that Europe has that fiscal, it has the monetary, and actually we'll be in a great place.
Do you think the ECB hikes next year?
I think that's pretty unlikely. The pricing at the moment, with 3 basis points is nothing serious. And so we think that inflation in Europe is a little bit more contained than it is in the States, in the UK, where we do see issues.
Isabel Schnabel this morning has told Bloomberg that she thinks actually the balance of risk on inflation and growth are to the upside. You've got the German 10-year that's just hit 2.82%. That's the highest since March.
Absolutely.
But everything's at the margin, right? So at the margin, do we need to price more tightening from the ECB, either greater risk next year rather than loosening?
This is the shift we're taking. We're going through all the developed markets at the moment. Australia's already done it, and they're on the tightening side. Canada's going to follow, and we believe that...
What does that mean for the dollar? Because the market's got this idea that we get a weaker dollar next year, and you brought that up just a moment ago. The kind of the Achilles heel of a lot of trading strategies at the moment is the dollar. If you get a stronger dollar next year, that undermines a lot of what people are positioning for.
We think that's very unlikely. And in fact, we're expecting a weaker dollar.
Right.
And that revolves around the fact that...
But you don't see the Fed cutting?
No. But what we do see is places like Japan raising rates more than is currently discounted. At the moment, they're only discounting rates going up to 1% in Japan next year. We think it's much closer to 2%. So there's big argument now about where's the R-star for Japan. We are very, very proactively believing that they're going to have to raise rates a lot more. You've got to look at what's going... sorry.
No, I was going to say that's interesting because, some of the data, yes, we've had some weakness in the GDP data coming through from Japan, which makes some people think, is it only going to be one and done from the BOJ, or is it going to be much more difficult for them to hike?
Yeah, no, there are some factors in that GDP data that are all, exogenous. What we would look at is what's going on in corporates. Corporate profits are up 19% this year. I think they were expected to be up 3%. You've got inflation at 2.8%. And you've got a massive fiscal stimulus coming from Takeshi. She's got 1.5% of GDP stimulus, $135 billion. At the same time, we've got monetary policy negative 2%. We see Japan and the Japanese economy doing absolutely fine into next year, and that's going to need the Bank of Japan to start firming rates much more than is expected. And that's going to cause money to start flowing back.
That's the repatriation trade that everybody's been waiting for so long.
Yeah. So it's not coming from the Fed coming down harder.
Right, you think it's because the BOJ's coming up.
Yeah, exactly. Yeah.
And is it driven then by that spread between the two? So the wider that spread gets, the bigger that spread gets. So even if the Fed does nothing, if the Japanese keep hiking, that brings some money.
Well, it narrows it, And
the market's making a bit of a thing about the fact that we seem to have dislocated away from the spread governing the foreign exchange. We think that's going to snap back. So you could actually see quite a big move as we go into next year.
Private credit, any risk there? Private markets, any risk there?
The whole story about lending, the private credit boom, we think is going to cause big dispersion in credit markets. And, we're going to find out who's been borrowing from private and from public markets.
Do you worry about the insurance link? People are talking to me about this now a lot. The fact that the insurance companies are big into private credit, big into private markets, and that link between the two markets.
We've got to worry about the insurers. We've got to worry about some of the pension funds that have overplayed this story. That the private credit run, which actually could be coming to an end when they change the rules on bank leverage, is something we're all going to be investigating.
Paul, great to see you.
Great to see you.
Thanks very much. Paul Skinner with some interesting outlooks for 2026, Investment Director at Wellington. Up next, we'll return to that theme of Europe. Does it have a problem?
Long-term strategy to help them become strong. A weak Europe is bad for us, it's bad for the civilized world, it's bad for the free and democratic world.
Jamie Dimon's view. We're going to have the latest on Ukraine, the EU and the ECB. All of that up next. We're going to focus on these comments from Isabel Schnabel and the politics around how Europe progresses next year. How important is that Germany stimulus going to be? We will find out. This is Bloomberg. Monday morning, good morning. Half an hour to go to the start of cash equity trading here in Europe. European futures are a little soft. We're down 0.2% as you can see, depending on your market. What is interesting is that US futures are a little bit more positive. We're up to 0.3%. Nasdaq futures up 0.3%. S&P futures up by 0.2%. So it's going to be interesting to see the kind of the opening trades and how they're going to work this morning and whether or not we firm quite quickly as we look forward to what's going to happen in the States a little bit later.
Yeah, futures here in Europe do look a bit sluggish then on the equity picture. Let's have a look at bonds then, Guy, and we've got really interesting lines coming through from the ECB's Isabel Schnabel, and that does seem to be having a bit of an impact. We see these yields going just a touch higher, up by 2 or 3 basis points or so, and I've just clicked into the German curve on the world bond market function, and I can see, yeah, we're up by 2, 3, 4 basis points actually at the short end, so 2 years we see the yield up by 4 basis points. So certainly these comments from the ECB having an impact. Let's get into those. The ECB's Isabel Schnabel says she's comfortable with bets that the central bank's next interest rate move will be a hike. Isabel Schnabel also told Bloomberg that she'd be ready to take over from Christine Lagarde if asked. Joining us now to talk about bond markets, Laureline Renaud-Chatelain, Senior Fixed Income Strategist at Pictet Wealth Management. Laureline, really great to have you with us. We're very glad to have somebody to talk about this story with us, because it does seem as if these comments have caused a bit of movement in the euro, a bit of movement in European bond markets. I mean, what's more significant to you, Laureline, the fact that she says she's OK with the next move being a hike, or the fact that she says that she would be ready to succeed Lagarde if asked?
Good morning. So I would say more the hike. What's important to look at is that when we look at the terminal rate pricing from the market for the ECB, it's really well anchored at 2%, meaning that the ECB basically doesn't move next year. Now, obviously, if we have one of the most important member of the ECB saying the next move could be a hike, and that potentially could come as soon as late 2026, then that needs to be priced in the market. And I think, as you mentioned, that also means that maybe the yield curve need to react a bit more to the upside to this risk, and something that is definitely not in the price right now.
OK, so yields go higher. I mean, what would you expect the Eurozone inflation situation, Laureline, to look like? Because on the one hand, just sticking with Germany, which is maybe what Isabel Schnabel knows best, you know, we've got the big fiscal push in Germany, which could push inflation higher. On the other hand, we've got China not exporting so much to the US and exporting a lot to Europe instead. So how would you expect the European inflation story to develop?
Yeah, I think it's very interesting that you really paint this dual picture of actually potentially upward domestic pressure due to the fiscal policy in Germany, but also downward inflationary pressure coming from outside, whether it is because of the strength of the euro or, as you mentioned, because of the deflation that is exported to us by China. So what we expect actually also because of base effect is a first quarter next year, European inflation should undershoot closer to 1.8%, so well below the 2% target of the ECB. And actually, our belief is that is enough for the ECB to stay on hold. The risk is that if we go closer to 1.5, then you could hear a lot more noise from the doves, and then we could consider a risk of actually a rate cut. So I wouldn't say everything is baked in for the ECB next year. Yep. It will all depend on this inflationary pressure.
Which do you think is more likely in 2026? A rate cut from the ECB or a rate hike from the ECB?
So at this stage, I personally believe that a rate cut is the biggest risk, because that's the risk where the market is definitely will be taken wrong-footed and where the yields could react the most. If it's a rate hike late in Q4 2026, that's potentially something that is a bit more expected by market participants.
How many more cuts do you think we're going to get from the Fed, and how divided do you think the Fed is going to be this week?
Yeah, so for this week, we definitely expect an additional rate cut. Now, obviously, we could have a surprise, but at this stage, we expect a hawkish cut, definitely, potentially with 4 dissenters. We'll see. And then when we go into next year, we believe that they go into a quarterly pace of rate cuts, meaning 1 in March, 1 in June. And obviously, everything in the second half of the year will more depend on who is the next chairman for the Federal Reserve.
Yes, talk us through, Laureline, your assessment of when the market starts to listen to the next appointed person. I mean, is it as simple as soon as we know their name, everything they say holds more sway? I mean, it's been well reported that Kevin Hassett could be the person, and maybe some of that is already priced into the market. So how does the market move from a place of listening intensely to everything Jerome Powell says to listening to the words of somebody else?
I agree with you with the fact that once we have the name, and if this person is quite vocal, the market focus will shift. But I guess the market will also listen quite closely to the other voting member at the FOMC. So to guess a bit where is the majority, because as you know, the chair has basically the most important vote, but it's still a voting process. And as such, it's not just one person that can completely change the direction of the FOMC in terms of monetary policy. So that will be key. And to our understanding, we'll have the name only early next year. So it leaves us a bit of time. And I agree, Hassett is seen as the most likely candidate from Polymarket. But, you know, last week we also heard that actually the Treasury Department did a survey among major banks to see how the market would take Hassett as a Fed chair. So it's interesting that they are still not sure about that.
OK, we've done the ECB, we've done the Fed. Let's talk about the BOJ for a minute. Our last guest suggested that maybe the BOJ could hike all the way up to 2%. A, how likely do you think that could be? And B, what would be the impact of a BOJ at 2%?
Yeah, so I would say first, not very likely. We're quite aligned with market expectation that the terminal rate is around 1%. Now, we could envisage something more aggressive, as you say. First, if inflation really doesn't come down. Second, if depreciation of the yen continues. And I think to your point, if they go to 2%, the biggest impact will be on the yen. And to us would mean a much stronger yen. And that potentially helps then the domestic inflation through imported inflation as well.
And does that mean repatriation? I mean, how high do rates have to go in Japan, Laureline, to get serious repatriation flows back into Japan?
So, to be honest, we were thinking that around 3% for the 30-year and now close to 2% for the 10-year, that could be levels where basically Japanese investor would be comfortable. And as you know, it's not very interesting for them to be investing in US dollar on the bond market once you hedge. But it seems that these companies, a lot of them have a lot of dollar, and they do prefer to still invest in dollar, the pool of assets that they have already in dollar. So it's not clear how much of this repatriation you will have, given how export-oriented or outside-oriented are the Japanese companies. So at this stage, it's still unclear, but we would expect, indeed, as you mentioned, higher yields mean more interesting domestic bond market.
OK. Final question. Let's talk about Switzerland. SNB. Inflation is on the floor. It's verging on going negative. Is there anything the SNB can do about it? And kind of what are the implications for Euro-Swissy and all the other factors we watch so carefully?
Yeah, so I think what you pointed out is that we have negative imported inflation. As you know, the Swiss franc has been very strong this year. And what is key now is that even domestic services inflation is falling. And to us, the key is this. So if this trend continues and it even goes into negative territory, then maybe the SNB will be first to cut. The problem with the SNB is that usually they try to also influence the currency. But you know that they cannot do that against the dollar anymore because the Treasury Department is looking very closely. So the only thing they can do is prop up that against the euro. But we've seen every time you have a bit of global market stress in the market, bam, the strength of the Swiss franc is very much alive. So that puts the SNB in a difficult position. So we believe if they have to, they will cut in negative territory. But obviously at this stage, they are reluctant. So we don't expect that for this week. Yep. But, you know, they like to surprise, so that could be the surprise of the week.
They do like to surprise. Maybe it's the BOJ that provides a surprise. Maybe it's the SNB that provides a surprise into Christmas. Laureline, great to catch up. Thank you very much indeed. Laureline Renaud-Chatelain, Senior Fixed Income Strategist, joining us from Pictet. wealth management. What are we going to be talking about next? Well, let's focus more on the geopolitics around Europe as well. President Trump has expressed his frustration with Ukrainian President Volodymyr Zelenskiy's handling of a U.S. proposed framework to end the Russia war with Ukraine.
We've been speaking to President Putin, and we've been speaking to Ukrainian leaders, including Zelenskiy, President Zelenskiy. And I have to say that I'm a little bit disappointed that President Zelenskiy hasn't yet read the proposal. That was as of a few hours ago.
So what does this all mean, and where does it take us next? Let's find out. Our Europe correspondent, Oliver Crook, joins us now from Brussels. Ollie, we're waiting for the next meeting surrounding this story. We've now got the comments that we've had from President Trump. How do we take these comments into the meeting that is going to take place today here in the UK? Keir Starmer preparing to host multiple European leaders, including Volodymyr Zelenskiy.
Yeah, so we'll look back a couple of days before we look forward. So on Friday, what we heard from the Americans and the Ukrainians who had been negotiating and discussing in Miami following that meeting with Witkoff and Putin a little bit earlier in the week, they said that they had agreed to a, quote, framework of security arrangements. So I'm not sure if that is something that is actually very concrete, that they have the actual ideas of what that will actually look like, or this is just a way to sort of preserve momentum into these talks. We also understand that there was a discussion between Witkoff, Kushner, and Zelenskiy on Saturday, and then on Sunday we heard from Trump basically disappointed that Zelenskiy had not yet been fully briefed on the discussions between the Ukrainians and the Americans. We expect Zelenskiy to be fully briefed today, and then we expect that meeting from between Emmanuel Macron, Keir Starmer, Friedrich Merz, and Zelenskiy today in London a little bit later today. We should say, Guy, that since the really beginning of these negotiations and over the last few months, these kinds of meetings at the top European level have basically failed to yield anything particularly concrete and move the conversation forward. I think what we will be watching over the next couple of days is any sort of reaction from Russia. You know, remember, the Russians haven't really been so endorsing of the framework yet. They've been much more guarded than the Americans have been. And we also need to basically, over the next week and a half, the Europeans will basically face do or die on whether or not to move on these Russian assets. At the end of next week, you have a European Council meeting with all of these sort of European member states having that meeting. If they don't come to an agreement by the end of next week, I think that this basically Russian asset question is basically frozen for the foreseeable future and will not move it forward any further. And that is really the crunch time for the next couple of days for the Europeans. And we should say that Friedrich Merz was in Belgium on Friday to help lobby with the Belgian Prime Minister, who's been one of the main obstacles to getting access to those assets.
Oliver, we've heard a lot from American voices about Europe recently. Jamie Dimon just over the weekend talking about how he sees risk in fragmentation and breakup and weakness in Europe. The Trump administration seems to be taking a different line, and we, over the weekend, got the national security policy, or on Friday, rather, got that national security policy articulated by the White House, which for many in Europe made some worrying reading.
Yeah, I think it's really an interesting document because, you know, a lot of the Trump administration, you have to sort of piece together from what people are saying a bit of vibe diplomacy. This really articulates very concretely with the seal, American seal of the president on kind of what the foreign policy and national security strategies are going forward. And I think for the European side of that, it's very, very interesting and very concerning reading for many here in Europe. I mean, the one thing he wants to obviously see a swift end to the war in Ukraine and Russia, but part of it is basically ending the perception and preventing the reality. This is quoting directly of NATO as a perpetually expanding alliance. He also talks about the continent facing civilizational erasure and saying that the United States wants to cultivate resistance to Europe's current trajectory within European nations, promoting these sort of more patriotic European parties and this sort of fighting against this loss of national identity within Europe. Going even further, saying that basically a number of the NATO allies, many of these nations, may not be composed by so-called Europeans in the next couple of decades, so unclear whether these nations will be the same kinds of nations that sort of signed up to the NATO charter initially. So contrasting to what we heard from Jamie Dimon, which is really promoting a stronger Europe and a more unified Europe, because that's very important to sort of American strength in Jamie Dimon's perception. This is sort of promoting, yes, a stronger military within Europe, but a more fragmented Europe, a Europe that is much more dependent on sort of national and sovereign identity of individual nations, which we should say also would have the benefit for the Americans of dealing with a slightly more docile Europe, a less unified Europe on issues of trade and other sorts of things. So less of a sort of great adversary from the Europeans, sort of promoting these national identities and sovereignty within individual nations, and less of a sort of holistic European approach.
Yeah, absolutely. So whether the US would gain or lose from fragmentation in Europe, a really interesting conversation. Ollie, thank you very much. Bloomberg's Europe correspondent Oliver Crook with the latest on Ukraine and US policy towards Europe. Coming up on the programme, we'll get back to the stocks agenda. L'Oreal is doubling its stake in the skincare maker Galderma to 20%. It's just one of the stocks that we're watching this morning. That's next. This is Bloomberg. Welcome back. This is the opening trade. Bridgewater Associates founder Ray Dalio says investors are not paying enough attention to the debt dynamics playing out across the world. He spoke to us earlier from Abu Dhabi Finance Week.
What's happening in all of these governments is that they can't increase their spending because they can't increase their debt. And at the same time, they have the needs, more military spending and so on. And at the same time, they can't cut taxes. And so you're seeing a lot of political turnover. In the UK, they've had 4 prime ministers in the last 5 years. Same has been true in France, because there's not the ability to deliver on the economic promises that they're making. So I think it's the confluence of that economics, that situation, and the politics, the debt dynamics working with the politics, working then with this technology adding into it in a bit of a technology bubble.
Bridgewater Associates founder Ray Dalio speaking there, and thinking about debt dynamics takes us on to thinking about yields and the cost of that debt. Our Markets Live executive editor Mark Covmore joins us now for 3 minutes on the markets. And Mark, the news flow this morning seems to be a lot about yields, things that will move bond markets. Certainly Isabel Schnabel getting the week started with something a little bit hawkish.
Absolutely. Schnabel is the news flow. That's the kind of the latest marginal development in terms of forcing yields higher. But the bigger, very much longer-term macro backdrop is exactly as Ray Dalio outlined. We just have a world which is where we've got kind of overburdened with government debt and fiscal promises that we probably can't deliver. And that means ultimately we're going to continue getting higher yields and probably have to monetize that debt. And that fuels anti-fiat trades. It fuels kind of inflation because we're essentially trying to inflate away that debt in a controlled manner. That is the bigger backdrop theme. And that's going to be a big theme into next year. Now, this is a very choppy time of year, but I think in the short-term dynamics around that theme, not only do we have Dr. Isabel Schnabel's comments, but we have the Fed this week, which is expected to be a hawkish cut, and we have JGB auctions. So there's a few dynamics this week that might help it in the very short term.
How important are the dots going to be this week? What are we going to learn from the dots? Are they useful going into 2026 with a new Fed chair coming in and so much uncertainty surrounding the US economic outlook?
They're not useful into 2026, but they're a massive tradable moment this week. This time of year is really interesting, right? This is a great market for traders. People are alert to kind of mispricings. Part of the reason it's such a good market for traders is it's actually quite bad for the macro person. This is not the time of the year to kind of get involved in those longer term trades, particularly ahead of the Fed this week. And then after that, we get a decline in liquidity. So, people wait till January to get really involved in the macro trades again. But it's because of that. It's because that kind of declining participation from the macro community that for traders, there's real opportunities. And so I think the dots will be super interesting this week. But no, they won't last in relevance until the new year.
Mark, we're getting some lines coming through out of China saying that President Xi says that they're continuously trying to expand domestic demand. And I guess some of the other news flow we got over the last 24 hours was around the export engine in China. No doubt, they seem to be able to cope with exporting less to the United States by just exporting to Latin America and Europe instead. I wonder how much that's going to be a dynamic that we need to keep in focus in 2026.
Yeah, I think it's an ongoing dynamic. One of the things that's really interesting this year is people get very focused on dollar yuan falling by the most in 5 years. That's purely a dollar trade. Dollar yuan is not a good measure of the yuan. It's a measure of dollar. It's a low beta proxy for the Bloomberg Dollar Index. In fact, the yuan on a trade weighted basis is having its worst year since 2017. So its worst year in 8. The yuan is depreciating this year against its trade partners, to most trade partners. And particularly you've seen the Euro-Yuan trade, which is really fueling its exports. And that's why China trade is holding up so good. And that's why the Chinese stock market is an outperformer, despite the fact they can't stimulate domestic demand. And I think that'll be a dynamic again next year because of the weak yuan. It'll help the Chinese stock market to outperform again next year, and it'll be an ongoing concern for the government as well to address.
Thanks, Mark. Great stuff. Markets Live Executive Editor Mark Cudmore. MLIV Go is the function on your Bloomberg if you want to get Mark's take and the rest of the team's take on what is happening in these markets. Big week. Let's figure out what the single stock story looks like this morning. Chloe's here, and we're starting with L'Oreal.
Good morning, guys. So yeah, let's start with cosmetics today. L'Oreal has doubled its stake in Galderma, which is a maker of Botox and fillers, to 20%. So L'Oreal had taken a stake of 10% last year, but now it's reinforcing that investment and trying to gain a stronger foothold in that injectables market. So we have seen Galderma shares doing really, really well over the last year. So we'll see if that continues. And if we also get a boost in those L'Oreal shares on the back of that investment, despite what has been quite a muted performance for L'Oreal. Moving on to the UK defence industry, and there are some concerns that UK defence spending is looking quite at risk. There's a lack of clarity on where the money is going to come from, and some military bosses are quite worried about where that money is going to come from. And so therefore we are going to be watching some of those names here today. They have been doing pretty well, but this could potentially lead to a little bit of weakness. And one of the co-authors of the Defence Review published earlier this year has said that some of the money from welfare could be redirected towards defence, and so that it could be seen as an act of self-harm not to do that. So we'll be keeping an eye on that sector as well today. And finally, JP Morgan has put a new note out today, downgrading Sanofi and upgrading Bayer and other names as well, including Novartis. So we'll be keeping an eye on those as well this morning.
Chloe, thank you so much. Our equities reporter, Chloe Melly, this Monday morning with some of the stocks that we're going to be watching. Coming up, we'll bring you the market open. European equity market futures suggest we will go a little bit lower. Yields are a touch higher across Europe on those lines from Isabel Schnabel. The focus, though, this week very much on the Fed. US futures pointing a little bit higher, up by 0.2% on S&P futures. So we'll certainly look ahead to that as well. The market open is next. This is Bloomberg.
OK, here we go. Fed week has started. We're about to see European markets getting going, expected to be reasonably quiet. This is the picture from Friday. Europe went out here. US markets kind of drifted sideways. US futures this morning are positive. European futures are a little negative. I'm not sure it's actually anything to do with this chart this morning. Could be a single stock story, could be a few other things, could be the stronger euro on the back of the Schnabel comments. Anyway, this is the picture. We're not down by much. Stoxx 50 futures 0.1%, FTSE futures 0.1%, DAX futures flat as a pancake going in to the market open this morning. We firmed a little bit, but we still have a negative picture that is emanating. But we've got US futures that are actually positive, so you wonder how long this is going to last for. Keep an eye on Brazil today. That could be an interesting story to watch out for, given what is going on in that market right now. But generally, when it comes to the main markets we are going to be watching, looks like it's going to be a quiet start, but a build into that Fed story, which we are watching so carefully, Anna.
Yeah, absolutely. The Fed, no doubt, at the centre of our week. Let's have a look, though, this morning, Guy, at some of the stocks that could be in focus at the start of trade. And we'll start with Galderma and L'Oreal. We've been covering this story this morning with Chloe earlier. L'Oreal is doubling its stake in Galderma to 20%. The French cosmetics company increasing its bet on skincare drugs. More extreme skincare seems to be something of a trend these days. Unilever in focus with its spin-off of Magnum, the listing of Magnum. So we'll watch what happens to Unilever and this new spin-off. We're going to see a triple listing in Amsterdam, London and New York. Amsterdam seems to have pole position, though, there. So we'll certainly watch how that is going down. December seems a strange time to focus on ice cream, but that's what we'll do. And we'll also look at these pharma stocks, because we've had an interesting note coming through from JP Morgan. Bayer, Novartis raised at JP Morgan among their 2026 top pharma picks, Guy.
OK, here we go. We've got to factor all that into our thinking. First thing this morning, we're not expecting huge moves from European equities. Keep an eye on what is happening in the currency market. Keep an eye on what is happening in the bond market. Those seem to be the stories that are more relevant this morning, particularly in the light of what we've heard from Isabel Schnabel. FTSE 100, nothing to see here. Flat, absolutely flat, not moving in any direction at the moment. We're down by 0.1% as anticipated, as is the Stoxx 600. We'll wait for the other markets to get going this morning. We'll see how quiet it is to see how quickly we get the German market open. But we are anticipating most of the European market story to be a little softer at an index level. Single stocks, I think there's going to be some interesting movement, and has already flagged some of that. The FTSE 100 has just popped positive by 0.2%. I wonder whether the miners are doing something this morning on the back of what we're seeing with copper. IBEX is out. It's up by 0.1%. The CAC is down by 0.2%. Net, what does this mean? The Stock 600 is doing nothing, absolutely nothing, negative by 0.04%. We'll wait for the DAX to get going in just a moment. What are the pharma stocks doing this morning? Is that a factor as well we need to think about? Anyway, let's see what the story is below the surface. Let's go sort of bottom up rather than top down. Anna, what do you got?
Yeah, let's have a look at some of these sectors that are on the move. And we've got standout performance from personal, consumer, discretionary and grocery stores. That seems to be the best performing sector, up by 1.3%. Not entirely clear what is driving that. Unilever is to the downside. That could be a bit mechanical. Of course, they're spinning off part of their business there. So we'll keep an eye on that one. I mean, maybe that's the Magnum story is doing that to that sector. So let's keep that in mind as we look at that one doing really well this morning. Industrial goods and services also up, and we don't have that many sectors on the upside, and we do see some of those defence names moving a little bit higher this morning, maybe not too impressed by the progress that has been made or lack of progress made over the weekend around Ukraine. So we see Hensoldt higher, ThyssenKrupp higher, Rheinmetall, Leonardo, Rolls-Royce, all of those a little bit higher than this morning. Retail is pretty flat, but also just into positive territory. Interesting, the basic resources story, Guy, that you referenced, we're down by 0.3% on that sector overall. So despite the fact that we see a new high on copper prices, that is the verdict of the equity traders.
What's driving London higher is Rolls-Royce, BAE Systems, GSK and AstraZeneca. That's where the point story is this morning. So it's defence and pharma that are doing the heavy lifting for the FTSE 100 in terms of where we're seeing maybe some outperformance coming through there. As you say, defensives are off. Unilever is the biggest drop, but there's Magnum ice creams to think about this morning. Always a good thing, even if it is December. And some of the energy stocks are also softer as well. But you've got HSBC a little softer, Shell's a little bit softer. So banks, some of the commodity stories dragging that market down to the other side. But that seems to be the story this morning across Europe as well. It's interesting that ASML is the biggest points gainer, but Roche is the second biggest gainer. So Pharma is where the lift is coming from.
Yes, absolutely. So we'll keep that in mind. Leave that to settle for just a moment. The start of European trade, the Xetra DAX just not yet open. We're pretty flat overall. US futures pointing a little bit higher. Let's broaden the lens. Talk to Fabio Bassi, cross-asset strategy head over at JP Morgan, about his thoughts, his thinking ahead of 2026. Really nice to speak to you, Fabio. So thinking ahead to 2026, you talk about uneven monetary policy. And yes, we're in a situation of flux when it comes to monetary policy in a number of places where we could see US rates being cut, the ECB on hold, and the BOJ hiking. We might not see those things, but that seems to be what the market is expecting right now. How does that play out for you in terms of your strategy?
That is our baseline as well. We are actually expecting the Fed to cut this week, to cut again in January. And after that, we believe that they will stay on hold for the rest of 2026. With actually the removal of some of these insurance cuts in early 2027.
Yep.
So the most important year for me, for the Fed, is the fact that we are reaching a sort of the end of the insurance season. 50 basis points have been delivered, 50 are more to come. And to me, it's interesting that given the ebb and flows around the December pricing that declined initially and now is almost fully priced, you're still in an environment where the market is still not sure about the cut in January. In our view, it's coming, because we expect further weakness in the labor market in current quarter, but we also believe that the current gap that you have between GDP and labor is probably going to close down in 2026 with an improvement in the labor market. And that's basically where we have a sort of the resilience growth outlook that has the, if you want, the downside of sticky inflation as well.
OK, so that's the US view. I mean, this uneven monetary policy is just one area where you see a lot of dispersion within 2026. You talk in your notes about deepening multidimensional polarization in stocks, the US economy and across consumers. I wonder if you could just expand on that a little bit, Fabio, on this multidimensional nature of the global economy in 2026.
Yeah, I think that polarization for me is the key word for 2026. We have polarization in the equity market between the AI stock called Max 7 or AI 30 and the rest of the market. We have a polarization in the economy between a strong capex and the rest of the economy that is not doing so well. And then when we think about the consumer, we have clearly a polarization between the top end and the bottom end of the consumer that people talk about K-economy. To me, the unfolding of these polarized dynamic are basically going to be a driver of macro and clearly markets in 2026.
Yeah, central banks are going to have a lot to think about next year, if you think about all of those various polls that are going to be factored into their thinking. Can I just come back to your views on the Fed, though? So you think they cut this week?
They cut again in January.
And they cut again in January, and then they're done, and then they hike in 27?
Well, I think that is more a balance of risk, in the sense that the official call is that they cut again, they hike early 2027 with the removal of 50 basis points of insurance cut. But to me, the important point of that message is that we are close to the end of the easing.
Exactly.
Market is overpricing the terminal, and the reason why the market is pricing the terminal is that clearly market needs to balance the risk of the downside. There is a left tail of the distribution that in our view is still there. We have about 35% probability of the economy ending in recession, and clearly conditional on that, the cutting cycle of the Fed will be much lower.
How does the equity market react in that kind of scenario? If we're done in January, and the next move is a hike, the equity market seems to be priced for a lot more cuts at the moment, and that is supporting valuations.
No, sure. I think that the challenge there is probably coming first from a repricing of the terminal. And if the terminal is going to be priced higher and is going to be repriced higher with still a slight inversion of the money market curve, so let's say in line with the last dot between 1 and 2 for this year and the one after, so you have a slow adjustment, then I think that the equity market is not going to take that badly, in the sense that probably you end up in a situation, and we have done some work, where if you have a repricing of the OAS terminal higher, what would you buy? You buy growth, you buy tech, you buy quality growth.
You still get double. You're talking about double-digit gains.
Our baseline is that they cut twice. Market will not focus on the pivot, because the pivot is going to take place only later in the year. And that's why we have an S&P target at the end of 2026 at 7,500. Clearly, if the market is going to deliver as much as what is priced, the upside is higher. But I also want to consider a situation where they pause, and later in the year you may see a potential pivot. That is clearly a challenge, probably more for the second half of the year.
Fabio, what's in all of this for Europe then? Defence stocks doing OK this morning. A lot of conversation about Europe standing on its own 2 feet, of course, when it comes to defence. That's going to continue to be a theme for investors, I guess, into 2026. What's your European focus?
I mean, we are tactically positive on European equity. We believe there is still upside here. And this is basically coming from the macro outlook that is resilient by fiscal story in Germany, that is basically putting growth rate that are higher than potential. We're talking about quarterly growth rate in Germany around 2%, at a regional level at 1.75%, which is something that is good by European standard. While I embrace the short-term tactical optimism on Europe, I'm still aware, as X-ray strategy, of the permanent structural challenges that the Eurozone is facing. The lack of banking union, lack of capital market union, energy dependence, lack of AI investment. To me, these are factors that should matter over the medium term. But clearly, we are happy as a tactical trade here to basically ride the wave and benefit from the fiscal impulse. On the ECB side, clearly a lot of debate this morning. My baseline is that it's most likely they will remain on hold for 2026, and our official call is still even 2027. I think that you have two tensions here. On one side, if I look at the projection of the ECB of core inflation at the end of the period, which has typically been the guide of ECB policy over the medium term, it was at 2, 1.9, 1.8. So there is an indication that maybe rates at 2% are not enough to trigger organic inflation in the Eurozone. On the other side, you have the new information coming from the German fiscal. Isabel Schnabel has a lot of faith in that dynamic that could counterbalance. Our projection on weight dynamic don't give us enough confidence that the next move is up. So I would say maybe 60% probability of rate on hold. 25 down, 15% up.
So probably on hold. What would the market make of an Isabel Schnabel lead at the ECB, do you think? Given what you just said there about the sort of German view and the German fiscal push and what that could do to inflation.
Well, I think the dynamic within the council is where the president of the ECB can clearly set the tone, but I don't necessarily anticipate a massive hawkish shift if you don't have the macro data warranting it. We are talking about a situation where inflation in the euro area is not going to be particularly high because of domestic reason, because of the wage dynamic, because of the currency, because of China. I think that the message from an hawkish president is not going to worry the market, particularly at current juncture. Clearly, if you move in a macro outlook where the rebound becomes stronger, then it could have a bigger implication.
October 27, I think, is when Lagarde's term ends. Talk to me about the dollar next year. So if the Fed's done after January and we start thinking about does the dollar go up or down? This is the bit that I'm wanting, because this, from a European perspective, this is really important. The performance I see on the screen in front of me is telling me I have not done well in US equities if I'm a Eurozone investor.
Yeah, sure. I mean, we still believe that the dollar has downside. We lower our euro-dollar target from 122 to 120. But we acknowledge that the risk of the Fed pivot is clearly the major risk here. But typically, if you are in an environment where the rest of the world growth is particularly strong, tend to be an environment that is good for the euro. And that's basically the environment that we are anticipating in 2026.
We're at 116 this morning, so that does imply, even at 120, some upside. Have a great Christmas.
Thank you.
Thank you very much. We'll see you again in 2026. Looks like it's going to be an interesting year. Fabio Bassi, cross-asset strategy head, joining us from JP Morgan. Call 6 looks like this morning. Let's focus on what we're seeing at the centre of the story. Defence stocks are up. ASML is up. You're getting some mixed performance coming out of the pharma sector this morning. We're going to focus on ice cream, though, because that's the big story in December. Ice cream, Magnum ice creams. Chloe Mellick, over to you.
Yeah, absolutely. Good morning, guys. So Unilever is down quite a lot this morning after the spin-off of its ice cream unit is now done. So the shares in the Magnum ice cream company will be starting to trade in London, New York and Amsterdam today. And so this puts kind of the focus back onto the prospects for Unilever as a standalone company. And it seems that investors may be a little bit worried about those prospects, and therefore we are seeing quite a bit of weakness in that stock this morning. Moving on to the Italian bank Monte Paschi, which is up this morning after an Italian newspaper reported that Italy's market regulator had ruled out that there was an undisclosed pact between Paschi and some shareholders in the bid for Mediobanca. So the news of that probe had really put pressure on those shares, and this is now lifting that pressure this morning, and we are up 3.3% for Paschi. Staying in Italy, and we have got Ferrari this morning that is down after being downgraded by Morgan Stanley, and that is because of Ferrari's decision to limit volume growth until 2030. So the idea here is to create desirability and exclusivity, but what Morgan Stanley analysts are saying is that this will also limit growth, and therefore we are down at 2.3% on the back of that downgrade. And finally, Bayer is up this morning after being upgraded. Well, Galderma and L'Oreal, let's start with that first. L'Oreal is down after doubling that stake in Galderma, which is an injectables maker, but Galderma is up on the back of that. It went up 2.6% this morning.
Chloe, thank you. Chloe Melly from our equities team with a host of movers then. Plenty to discuss, including the listing of Magnum. So coming up on the programme, Magnum debuts in Amsterdam after Unilever completes its ice cream demerger. That conversation coming next. This is Bloomberg.
Welcome back. 17 minutes into the equity market session. At a top-down level, there's nothing to see. Nothing really happening. At bottom-up level, there's some actually quite interesting stock stories developing this morning in Europe. Take a look at what's happening with Ferrari. Some of the defence stocks are on the move as well. There's also the story around what is happening with Unilever. The world's largest ice cream maker begins trading today in a rare triple listing, Amsterdam, London and New York. We've got the demerger of Magnum ice cream taking place. So this is coming out of Unilever to sort of standalone status. on these markets. Now, the reference price was $12.80 Friday, so we're trading a little softer than that. I am going to make a big effort here to push as many ice cream jokes into this section as we possibly can, because I know that Charlie Wells is going to do exactly the same. And I feel there's some sort of competitive spirit here. So I've already got, it's got a 1 to me so far. You're here with the scoop. I think that's 2 to me. What else have you got?
Guy, I think I need to just stop while I'm ahead because I'm just going to crumble.
Okay. I'm not sure that counts, but okay.
That hardly counts. See, case in point. But look, I mean, this is a really interesting story because basically it speaks to this standalone pressure that Peter Terkulva, who is going to be the CEO, who is now the CEO of the standalone company,
Yep.
He's got to communicate a complicated story to investors, right? This idea that the Magnum ice cream company is stronger alone, that they can, focus less on delivering returns and more on growth. This is a really difficult time to be a junk food company, right? Because we've got GLP-1s everywhere. We've got consumers less inclined to eat these unhealthy foods. How do they change that narrative? How do they roll out products that they can meet the consumer with, right? Healthier products, products that can, say, hydrate the consumer. I think looking at this business, we know that analysts like management. They like Terkulva. They think he can deliver. They also like the balance sheet, right? It's free cash flow positive. It's profitable. And the estimation is that this will start trading at about, or at least eventually land at trading about 10 times EBITDA. So we might see some gyrations early today, but once it settles, it could look pretty healthy.
Okay, where does that leave the demerger from Unilever? Where does that leave Unilever? Because, decades ago, this was a food company. Now it is much less a food company.
And we already saw Chloe talking about how share prices for Unilever are under pressure this morning. And so, I think there was one story where, freed of this ice cream company, they could focus more on high-margin businesses. I think the other story is one about the conglomerate, right? And is the conglomerate dead? We've seen conglomerate discounts across Europe, across the board, as investors kind of have questioned, does this diversification actually play off in a time when the world seems to be deglobalizing, when supply chains are really complicated? And I think that was one of the issues with the Magnum ice cream company, is that supply chain was really complicated. Just spinning that off kind of benefit Unilever, at least in the short term. It doesn't look like it is right now.
Triple listing? Why?
3 scoops.
Oh, yeah, okay.
I recycled your joke.
Set you up for that one.
I recycled your joke. And look, there was a lot of jockeying, right? There's been, as fewer companies in Europe and elsewhere go public, as fewer lists, there's more competition, right? London competing with Amsterdam, competing with Stockholm. Primary listing in Amsterdam, that's not going to bode well in London. And the government here has really been trying to amp up the attractiveness of the city for listings. They lost out on that.
Yeah.
There was talk that this could happen in New York. But there's also some procedural issues, and I think we'll see this play out throughout the day, of forced technical selling. And so there are some concerns that, funds may have to sell, because this won't be automatically in Stocks 50, etc.
Okay, so small or large, Magnum, personal choice, almond, my favourite choice, but there are other ice creams available out there.
The bigger the better, the more chocolate the better, but cocoa prices have really been putting that under pressure.
Okay, so you're not in the white camp. Some people are in the white camp. No. Oh, no, Anna's not.
8:21, it's too early for all of this. That is December, which is a strange time to be talking about ice cream. Charlie Wells, we thank you very much for joining us. Bloomberg's Charlie Wells with the latest on that spin-out from Unilever. Let's go to other corporate news flow this morning. US President Donald Trump has raised potential antitrust concerns over Netflix's planned acquisition of Warner Brothers. The $72 billion deal would combine the world's top streaming player with the number 4 service, HBO Max, which has raised red flags from regulators.
He's done one of the greatest jobs in the history of movies and other things. And he's got a lot of interesting things happening aside from what you're talking about. But it is a big market share. There's no question about it. It could be a problem.
Joining us for more, then, is our deals reporter, Manuel Bagori. Thank you, Manuel, for being with us. So how seriously should investors and deal makers maybe take Donald Trump's antitrust warning? He did say this has got to go, into a process, but he was certainly raising a few concerns.
And it's a great question. It remains to be seen how smooth or how bumpy the regulatory approvals for this very large transformative deal will be in the months ahead. Obviously, investors are watching that closely. Deal makers in general, it's in everybody's head, right? It's like, okay, this is a really massive deal, but how plausible is it that they go from signing the agreement into completing the deal. We've seen other major deals falling apart in that process. There could be a lot of holdbacks, whether the FTC or whether other regulatory bodies will look into it and will analyze the critical issues, how that will ultimately impact consumers and how much market share Netflix will ultimately have, whether or not there might be some asset disposals that need to come out of that. It's still too early to call it, but obviously the first step, Netflix prevailed in that auction for Warner Bros. You know, a really large deal. Yeah. Also a very kind of rare move for Netflix, but it's still not quite a done deal for sure.
Could they restructure this deal? Is there anything they can do to this deal to make it more regulatory friendly?
Yeah, Guy, I mean, that obviously is something that during the negotiations of this deal and any deal is always analyzed. What is the plan B, whether if antitrust regulators, you know, kind of step up and scrutinize a deal, what are the alternatives? I am sure there has been a lot of analysis, you know, going on behind the scenes, and obviously the lawyers, especially the antitrust lawyers, will kind of, you know, look very, very deeply into this for months. Obviously, they've been analyzing that. Now, how and when and if the deal could be restructured remains to be seen. Also, just bear in mind there is this massive $5.8 billion breakup fee, right? So that also gives some reassurances to, you know, especially Warner Bros. In the case that the deal doesn't materialize in the end and they have to start it all over again. Obviously, it's a massive distraction for the companies during that process. And there will be a lot of questions raised. There will be a lot of people who are more or less vocal about the benefits, the pros and cons of getting this deal, you know, through the finish line. But in terms of restructuring the deal, obviously, different options will be on the table.
Yes, Manuel, I want to ask you about tech and media coming together. I mean, Phil, Netflix is a media business, surely, but sometimes we think of it as a tech company. In the past, that's raised eyebrows, tech and media coming together. It's not always told us great things about valuations. I wonder what this means for the industry, this particular tie-up.
Yeah, Anna, I mean, if we look back at the industry within not just tech and media, but actually the overarching telecoms, media and technology, also known as TMT, we've seen a number of permutations within the three segments, right? We've seen telecom companies building and buying tech companies. We've seen media companies converging with telecom, and we've seen tech companies converging with media and telecoms. I mean, the three of them come together, and there is different iterations across different times, you know, over the years in which we see the three of those kind of coming together and then kind of like separating. Now we're seeing, as you well said, media and tech coming together. I think it sets a precedent for other potential deals in this space, but I wouldn't draw too much of a conclusion because these different entities across the TMT spectrum come and go all the time over history. Some of them are successful, many of them have proved unsuccessful, so it remains to be seen on this one in particular.
Okay, Manuel, great stuff. Thanks for the update. Manuel Baguri joining us on what is happening with the Netflix transaction as they go ahead. Coming up, we're going to look into the corporate AI integration story. Melissa Mulholland, CEO of enterprise software provider Software One, joining us next. This is Bloomberg.
Welcome back. This is the opening trade, 30 minutes into Monday's session. Let's have a look at how that session is developing. Well, it's a pretty mixed bag, actually, Guy, right now. The CAC 40 getting some losses. Elsewhere, we're pretty range-bound, pretty flat across these European equity markets. Not a huge amount of corporate news flow to trade around. There is the listing of Magnum ice creams. Maybe that's where everybody's thoughts are heading this morning. But we have a fairly flat picture. US futures look a little bit more positive. We'll wait to see whether that is delivered on. And, of course, midweek, we get to a Fed meeting, and that perhaps is going to remain the sort of news overhang into the middle of the week, Guy.
Absolutely. Let's take a look at the internals and figure out what is happening here. As Anna says, balanced is the word of the morning. 272 up, 330 down. I think that's quite balanced. In terms of what we're seeing on volume, it is weak. Now, what is interesting is that actually this number has been weak over the last few days. Now, remember, this is a 20-day average, which tells you actually maybe the average is also coming down. So just bear in mind that we are going into December, despite the fact we've got the Fed, the ECB, the S&B, so many other things that we need to be thinking about as we work our way towards the end of the year. The BOJ could be the kicker towards the Christmas period. Let's talk about where we're seeing some of the leaders and laggards in this market this morning, just to delve into the single stock stories. Tech is bid. ASML is up by 0.5%. Obviously, that's going to do a heavy lift considering its weighting. Bayer is also up. There's a very positive JP Morgan note out this morning. Keep an eye on that. Rolls-Royce, some of the defence stocks are also gaining ground as well this morning. So you've got Rolls up, you've got Rheinmetall up. The aerospace sector generally catching a reasonably decent bid. Downside looks a little bit like this. You've got some pharma stocks that are on the back foot as well, which are worth watching out for. Novo soft. It's interesting to see what's happening with Bayer. You've also got split in tech. So you've got the chip sector up, SAP down by nearly 1%, and Unilever. Unilever's the ice cream story. This is the Magnum story that we've already talked about this morning. Unilever dropping nearly 4%, Anna.
Let's focus in on some of the other news flow that we are keeping on the agenda this morning then, Guy. The ECB Executive Board member Isabel Schnabel has said she'd be willing to take over as president when Christine Lagarde's term ends in less than 2 years. Front-runners for the role are thought to be the Dutch Central Bank chief Klaas Knot and the Bundesbank president Joachim Nagel. In a recent interview, Schnabel also signalled that she's, quote, rather comfortable on bets the European Central Bank's next rate decision could be a hike. President Trump has expressed his dismay at Volodymyr Zelenskiy's handling of a US proposal to end Russia's war in Ukraine. The statements contrast with some recent, more optimistic comments from Washington suggesting a framework of security arrangements had been agreed with Kyiv. Trump's comments come ahead of President Zelenskiy's planned meeting in London today with the leaders of France, Germany and the UK. And China's trade surplus has topped $1 trillion for the first time, despite a deepening plunge in shipments to the United States. Exports returned to growth in November, rising 5.9% from a year earlier, after an unexpected drop in the previous month. Meanwhile, China's Xinhua news agency reports that the country's top leaders have made strengthening domestic demand their top economic priority for next year. We keep, Guy, getting these comments from the Chinese authorities that they will focus in on domestic demand.
The data's not there, though. You look at the data this morning and figure out what is happening in terms of the export story. The November data and the surplus that China is delivering on exports, extraordinary. 1.1 trillion is the number that we are looking for here, have got here. And what is interesting is that exports to the United States are down by 29%.
Yeah.
But they're making up for that in Latin America and in Europe, which takes us on to the Macron comments. He's just come back from China. He is deeply concerned, clearly, that actually China is not going to play ball and is not going to balance the trade between Europe and China. And as a result of which, he's saying maybe the Europeans need to follow the US route and start to make tariff noises and potentially start to sort of cut that trade off.
Yeah, I mean, Chinese competition in focus on many fronts, possibly on the tech space, the AI space as well. Let's talk about AI. We do that daily, it seems. 3 years into the AI boom, agentic AI is supposed to be the next productivity catalyst. But our next guest from Software One says that the economics doesn't always add up, with hidden costs and barriers to scaling eroding the return on investment. I should also point out that whilst we're talking to the company recently confirmed it was the target of alleged insider trades, with authorities across Europe carrying out searches as part of an inquiry. Software One has made clear that the company itself is not under investigation or accused of any wrongdoing. Joining us now is Melissa Mulholland, the co-CEO of the global technology solutions provider Software One. Melissa, nice to speak to you. Thank you.
Thanks for
joining us. So let's just deal with this latest news flow, I suppose. Let's start with that first, and then we'll get back to the AI conversation, which is really where we wanted to focus our time with you. So you put out a statement. The searches of various offices of Software One have taken place in connection with alleged insider trading by non-executive employees. Any update? Anything else you can tell us about what's happening on this front?
No further comments. Outside, the company is fully complying with authorities. And as I mentioned, this is only subject to few individuals in the company, not at the executive level.
Okay, but the investigation continues, and you're complying with authorities. Okay, so now we've dealt with that one. Let's turn to the pivot to the AI conversation, because we are looking for clues always as to how AI is actually making a difference on the ground for corporates. It's all very well to think about the data center build out, but what are companies really going to do with it? Will it deliver on productivity? And you raise a few warning flags. Tell us your experience.
AI is transformative, that's without a doubt. However, most companies don't think about the implied costs. It takes discipline. It just takes decisive action as CIOs across the world are faced with multiple cost additions. For example, when you have agent sprawl, so multiple agents being deployed across an organization, data governance, security, also cloud costs. So oftentimes it's not just about implementing an agent and it solves and delivers return on investment, but in fact, oftentimes companies experience higher costs because of the other aspects that they have to think about with people.
There's this whole expectation at the moment that companies are going to deliver massive productivity as a result of agentic AI, the use of AI. You're telling me that that actually looks harder to achieve than maybe the kind of the zealots of the AI world are suggesting?
Absolutely, AI will deliver productivity gains, and we know that to be a fact. But it also requires holistic business planning. Oftentimes, organizations don't think about that end to end because you have to think about employing your people. You have to make sure that those people know how to use the agents, as well as to maintain and the governance associated to it. So you have to look at the holistic cost. And oftentimes, companies just assume implementing AI, they're going to have return on investment immediately.
But you're saying it's more expensive at the moment. Is that what you're saying? You're saying it's more expensive at the moment to use this stuff than maybe to employ humans? Am I correct in that assumption?
It depends on the use case, and it depends on the model. So if you have a very specific use case you've planned out and you've organized your people to be able to deploy it, then it can deliver return on investment.
How many companies have you seen doing that well?
I would say probably 30% if I were to articulate, and most companies don't think about the holistic aspects. So, for example, we have a Swedish-Finnish finance company where they actually deployed agents. They resulted in 13% revenue savings, but they overspent their budget by 80%.
Wow.
So that's what can happen if you don't have an articulated plan and businesses aren't thinking about how to ensure that their people are trained and are using the AI agents.
So what are these quiet costs then, Melissa, that get into this process that are not foreseen?
Security, data governance, also making sure all of your data is in the cloud. There are a reason that hyperscalers and companies want to have these agents be deployed. So making sure that your data is in place is key. Also, retraining and ensuring that people, the employees, know how to use the agents is vital. Because at the end of the day, it's an adoption and change management. For all of us, learning how to prompt and use this to get ROI is essential, and that is a key component of it.
Is the reality that a lot of businesses are dealing with a lot of legacy? I mean, you mentioned a financial services business where I think of lots of systems that need to be very carefully managed. Security is really important, and sometimes these systems are pretty old. I mean, is getting all of the data into a system that is modern enough to give you the benefits that you need from agentic AI, is that part of the problem as well?
Absolutely. A lot of companies, especially here in Europe, actually aren't fully in the cloud. Think public sector, government, that needs to be fully transmitted into the cloud in order to access all of that. And then if your IT security...
Why does it matter if it's in the cloud, or can you not have it on premise and still use the data that you own as long as it's structured in a way?
You can, but of course it's more complex. And so depending on how that data is structured. So that adds additional element and costs. And I always say that you need to have a human in the loop. AI is not going to replace humans entirely. At the end of the day, you need to make sure that all of that knowledge and business capability is also factored into the agents. And so these are costs and these are elements that companies have to think about. So yes, AI can deliver ROI. And yes, will it be transformative to our society? Absolutely. But it also is important that companies think holistically about how they're going to deploy this.
If the cost of AI, how big a problem is the cost of AI that I'm being charged for using AI at the moment? Because obviously we've got this huge data center build out, chips are incredibly expensive, GPUs are incredibly expensive. There's a lot of kind of expense at the moment. And at some point, you do wonder whether there's going to be a kind of clearing and ultimately we end up with a cheaper cost of AI, which actually allows it to be integrated into many more companies. So how big a factor is the actual cost that companies are being charged at the moment, not just they're sorting out their own security and all their own internal costs? How much is the external cost of AI a problem at the moment?
It is a problem. I would say that for a lot of companies, you have to count the additional cloud costs, including my own company. At Software One, we're going through a big integration process, and I have to think about the costs incurring with it as well. So that is a factor. But I do predict that the costs will decline over time and become basically the essential costs of electricity as we have more data center capacity in market, which is, of course, what most of the large cloud-based public cloud companies are working on.
And do you see that decline being smooth, or do you see it being choppy?
I think it will be steady going down. I don't think it will be smooth. I think it's going to take some time for this to actually go through, as a lot of data centers are being built out across the world.
Melissa, thank you very much. Thanks for giving us your time. Melissa Mulholland, co-CEO of Software One. Coming up on the programme, we will be talking about commodities. Tulan Nguyen joins us, commodity and FX research head at Commerzbank. Copper hitting a record high actually links in to that tech story we were just talking about, the role of copper in the AI build-out, just one of its use cases, of course. That's next. This is Bloomberg.
.45 minutes past the hour. Welcome back. You're watching the opening trades. This is what we look like 45 minutes into the equity market session. It looks remarkably similar to how we looked at the open. We have moved a little bit, but not much in 45 minutes. There are things happening in other markets, though, that are worth paying attention to. Look at what's happening in the bond market this morning. Look at what's happening in the commodity market this morning. Copper is at an all-time fresh record, I think, this morning, or close to it. I think, what are we up, 30% so far this year? I can't quite read that number. Just over 30%. It's an amazing performance that we are watching here for copper. And there's a number of different drivers. Clearly, the AI trade is part of that. We've also got China this morning out setting domestic growth as being its top economic priority. That's certainly a driver of the copper story. Tulan Nguyen, commodities and FX research head at Commerzbank, therefore perfectly timed in joining us to discuss all of this. Tulan, good morning. Copper's up over 30%. How much further has it got to go? How much of a problem is this high price? Do we see substitution? What happens next in this trade?
I think there's actually still some more room to the upside. We ourselves, we forecast that copper can hit the 12,000 mark next year on the back of obviously supply constraints and at the same time demand increasing. We've obviously been saying this for a while. Structurally, copper is obviously strongly in demand due to the energy transition. And I think now with the supply constraints, this is leading to a sort of a supply squeeze in copper at the moment.
Okay, sounds like you're having a busy morning. Let's carry on with where this could take us. If we get to these kind of elevated levels, do I get into the aluminium trade? What happens next in some of the adjacent trades around the copper narrative?
Well, I think right now the focus is very much on copper. I mean, if you look at the trends on the base metal markets, we've seen quite divergent trends in prices. Obviously, aluminium has been up, but on the other side, nickel or zinc have been underperforming. So this is really a copper trade because the focus is on supply. It's very special in the case of copper, where we have these issues in the mining sector, which we don't have in the other sectors. Yeah, maybe to some extent, we will see a common uptrend due to economic recovery in the course of next year. But really, this current copper price strength, this is only common due to the supply situation in copper. And much will depend on how metal production next year will eventually evolve. If we will actually see, especially in China, that production starts to stagnate or even decline, and that will will be essential and how far the copper price can still increase. At the same time, we need to remember that a higher copper price is needed, in fact, in order to attract investments in mining. So further out, over the medium term, long term, the mining production can increase again. And for that, a higher copper price is actually necessary.
Yeah, you mentioned China and the relationship between copper and Chinese demand. Tu Lan, good morning to you. What about on the oil side of things? What are you seeing now in terms of China's buying of oil and what that tells you about the Chinese economy and where we are there?
Well, in terms of the Chinese economy, actually, we're seeing that it's kind of two-way, right? The domestic economy is actually weakening. So that stands in contrast to the observation of very, very strong crude oil imports that we're seeing. We just received the newest numbers, which hit a 2-year high, as far as I know. But what is happening is that the oil is not being consumed, but it is put into inventories. So what is happening, not only on the energy market, but in other markets as well, that we are seeing sort of a stockpiling in China. I think this is a preparation also for the medium to longer term in order to have enough essential commodities in order to meet demand. But right now, it's not needed. Consumption is weak, so all of this is going into stockpiling.
Tu Lan, what's at stake for the commodities sector when it comes to the Fed this week and the Fed conversation going into 2026?
I think in the short term, actually, the Fed could provide some headwinds for commodity prices because obviously a rate cut is already priced into the market and has supported certainly cyclical commodity prices. But the focus obviously is on what will the Fed communicate as regards the medium-term outlook. And we could imagine that seeing that the FOMC is quite divided in terms of how to go further with rate cuts, that we will see a rate cut, but at the same time, communication will be rather hawkish in order to appease the rather hawkish members in the FOMC. So that actually could provide some headwinds for commodity prices if rate cuts further out are being priced out.
All right, we'll see if that hawkish language comes to pass and what it does to commodities then, Tu Lan. Thank you very much for joining us. Tu Lan Nguyen, Commodity and FX Research Head over at Commerzbank. Let's round out the hour with a look at what is still to come this week when it comes to the data points we're watching, the set-piece events. We get US JOLTS data today. We're still catching up, aren't we, from the shutdown and some of the data we missed. Rachel Reeves will be testifying to the Treasury Select Committee. Of course, we get a rate decision from the Fed middle of the week. The SNB, their rate decision on Thursday, and UK monthly GDP for the UK rounds out Friday. Who on earth could we talk to about all of these things, Guy?
She's over there.
She is.
Set me right up.
Okay.
My favorite topic.
Fed?
Fed
Go.
decision. Fed decision on Wednesday, and honestly, I mean, I don't want to say this lightly, but it could be historic in terms of the amount of the dissents that we get.
Yep.
If all of those hawks who flapped their wings a few weeks ago decide to dissent against the rate cut, we could be looking at 5 dissents, which is something that hasn't really happened very often in modern Fed history, going back all the way back to the 70s, for instance. So all of this disagreement is really about cutting interest rates alongside inflation still being above target. We had many hawks saying they're uncomfortable with proceeding to do so.
Yeah.
Yet you have, on the other hand, the more centrist parts of the FOMC Council, that be it John Williams,
Yep.
who said he was supportive of a rate cut. Many see him as sharing Powell's views. The market is pricing in a cut on Wednesday, but it's all going to be about how muddled of a message are we going to get as Powell tries to appease both hawks and doves.
I have no idea who's going to make all the decisions next year at the FOMC. Is it Kevin Hassett? Is he going to be the Fed chair? Who's going to be sitting on the FOMC? How does this whole process work? We've got the Lisa Cook case coming up, which feels hugely significant to me. I'm looking at 2026 and thinking, it is so hard to call what the Fed is going to be doing. Are the dots useful today, therefore? I don't know. What's the story going into next year? There's so many imponderables around this organisation.
Yeah, really a fractured Fed. This doesn't really happen often. Again, though, we're very likely to get a dovish Fed chair. That's something we do know. Who is it going to be? Kevin Hassett, maybe, but still, there's a long process for the nomination to then go through the confirmation in the Senate. We have until May, obviously, until Powell steps down. And then we also have to remember the Supreme Court case, not only the one on Trump tariffs, but the one overhanging Lisa Cook. The U.S. Supreme Court isn't expected to hear those arguments until the end of January, but they are hearing arguments around the dismissed FTC commissioner. That is happening today. Give us some clues on how the Supreme Court might be lining up to treat Lisa Cook.
Yeah. I'm wondering about the level of dissent in 2026 then. And I mean, you know, maybe that's bad for risk assets, but maybe it's cathartic. Maybe it's a good thing. We get all these views expressed, Val. Let's not discuss that now because that will take us longer than 4 minutes, which we have left on this conversation and this programme. Let me ask you about Wall Street and the risks they're pricing in because Wall Street has been assuming that we get lots of rate cuts. Not sure how that rubs up against the hawkish language. But is Wall Street just looking ahead to 2026 and going, we'll just carry on doing what we were doing?
Yeah, I know. It's, I guess, you know, it's refreshing to see all these 2026 outlooks, everyone out with their rosy views of what the year could entail. Obviously, we have no idea. But many of them assuming we are headed towards double-digit gains for the S&P 500. That's when it comes to Wall Street and the banks, the trading houses' views. Bloomberg also did a big survey of the more large asset managers, be that BlackRock and Allianz. A huge majority of them are very optimistic on global stocks. A very large majority optimistic, not only on U.S. stocks, but global stocks in nature. Maybe a lot of this is contingent on the Fed continuing to lower interest rates, but that is also contingent on where the inflation narrative goes here. And I want to bring in China into all of this because I think the data that we got overnight can be really quite interesting to what how people view inflation going into next year. China is clearly having an issue with overproduction. Their exports are screaming higher, a lot higher today, at least for the month of November, than the market expected. And this could lead to many assuming that China is going to be a big disinflationary impulse when it comes to goods prices across the globe.
But their exports to the US are down by 29%. So it's a differential factor for different central banks to worry about. It's interesting that Macron's out with his comments relating to this, which takes us actually onto the ECB. You've now got Schnabel. It's a long way away.
2027.
Yeah, well, maybe. Late 2026.
She's comfortable with the job if you want to give it to her early, though.
Yeah, but she's hawkish. She's clearly hawkish. And she's already introducing the idea that there's a debate around when the next hike starts. So that clock is now ticking.
Clock is ticking, and it's funny. I mean, obviously, most policymakers or more European politicians do want an accommodative central bank, and here she is out saying that she's comfortable with the next move being a rate hike. But it comes alongside some pretty unusual comments made from Macron. He did talk about the sole mandate of the ECB, which is just inflation, and hinted that perhaps that they should look at targeting things like growth or like employment, like the Fed does. So perhaps we could see a politicized ECB when it comes to their reappointment.
So it's interesting. I read a piece over the weekend talking about the Fed should go back to a single mandate on inflation because the growth stuff is so all over the place.
Growth is looking so good.
I'm not sure what President Trump would make of that. Not sure that's speaking his book. Thank you very much, Valerie. Thanks for joining us. Bloomberg's Valerie Titel with a look ahead on the markets. US futures fading a little bit just now as we get towards the get into our stride here in Europe.
Yeah, they are. We're up a little bit, but not by much, as you say. Anyway, that wraps things up for today. What have we done today? European markets have started the week. We spent a whole kind of focus on ice cream. Anna doesn't like white Magnums. I think that's a story we can take away. Anyway, hope you enjoyed the show. This is Bloomberg.